Guys, I want to start with General Motors because it is a big move for GM. Last I checked, they were up something like 11%. Allie, let's start with you.
Stock is up well over 10% at this point in pre-market trading, Julie, and this comes despite a mixed earnings picture, but a big boost to full-year guidance, along with more optimistic rhetoric around the tariff picture. So earnings came in ahead of estimates, whereas revenue slightly missed. But if we take a look at the full-year guidance, GM now says it expects full-year earnings between $9.75 and $10.50 per share. That's up from its prior range. And also said that adjusted EBIT could top $13 billion. Now, EBIT, or earnings before interest and taxes, is a key measure of operating profitability. So it basically tells us how much GM is making from its core business. And this comes even as the company does continue to grapple with the weight of tariffs. The company now estimates that will register a hit of $3.5 to $4.5 billion this year. That's slightly better compared to what we saw in the spring. CEO Mary Barra striking a more optimistic tone when it comes to the future. She did thank the Trump administration for new tariff mitigation policies that will make companies like GM and other U.S. manufacturers more competitive. GM does expect those offsets to cover about 35% of tariff costs. And then if we zoom in on the quarter, I mentioned how earnings came in ahead of estimates. $2.80 per share for adjusted EPS. Revenue came in at $44.3 billion. Again, light of estimates. And then adjusted EBIT, that came in stronger than expected at $3.4 billion. So overall, a mixed earning picture, but that full year boost and more optimistic tone helping drive shares with those double-digit gains that we're seeing early this morning, Julie.
And Allie, what specific vehicles really drove this? I think pickups, right, were part of the picture?
Yeah, those gas-powered pickup trucks, those SUVs, those continue to drive a lot of the momentum that we saw in the quarter. U.S. sales rose 8% to more than 710,000 vehicles. This represented GM's best market share since 2017. EV sales also hit a record 66,000 units. Now, that comes ahead of the expiration of those federal tax credits. So GM did warn that from here, EV demand is going to slow substantially. The company did take a $1.6 billion charge linked to its EV reassessment, saying, quote, near-term EV adoption will be lower than planned. Still, over the long term, GM does remain optimistic about this business, and they basically describe this slowdown as an opportunity to better the product in the meantime. Here's a look at what GM CFO Paul Jacobson told our executive editor Brian Sozzi early this morning.
This slower demand is going to give us an opportunity to improve our battery chemistry and our form factors, realizing thousands of dollars per vehicle or savings, and ultimately be in a position to scale up as the consumer does.
So basically right sizing now to hopefully win later. Now, a big question is not just the function of these vehicles, but also the infrastructure. That has been an issue when it comes to how quickly consumers have wanted to adopt to EV vehicles. So we'll see how that goes down the line. But for now, investors clearly cheering the report, up over 10% in early pre-market trading.
All right, General Motors is out with much better than expected earnings and a raised full-year outlook, but the auto giant is still warning that tariffs from the Trump administration will hammer profits by as much as $4 billion. The company is also restructuring its EV business as it takes a more subdued view on the industry's outlook. I caught up with GM CFO Paul Jacobson earlier today on the NYSE trading floor to get an inside look into the results and outlook.
Well, I think this is just a testament to the resiliency of the GM team. When you look at what we've done over the last several years in terms of reducing our inventory levels, being lean, and being able to respond quickly to the changes around us, this is just another example. And as we started the year, tariffs were all the noise, and we said that we were going to be able to adjust and work through it. And now we're on a track to be able to lean on that track record and ultimately look to a 26 that could be better than 2025.
If we were to have this conversation in April, when the tariffs first hit, I think this would be a different conversation. But I mean, tariffs are still impacting your business, right?
Yeah, so we revised We revised our guidance downward on the tariff side to by about $500 million. So tariffs are getting a little bit better, but I think the important message for the street is that it's stabilized. So as we look at Korea getting finalized, and hopefully as we get into 2026 with Mexico and Canada, and then the announcements that the administration just made on Friday with the expansion of the MSRP offsets, we really feel like we can be successful in that. And it's administration that really wants the U.S. auto industry to be successful.
Within your business, where are you seeing the most pressure from tariffs?
Well, I think we've seen it across the supply chain overall. You know, we announced $4 billion of capital expenditures over the next couple of years to bring more U.S. assembly or more assembly into the U.S. and onshore. So that's really what we've had to do is adjust to that. So as we work with our suppliers and we work with our own manufacturing footprint, that's something that over time we think we can get back to the 8 to 10% targeted margins in North America.
That, $4 billion hit this year, or $3.5 to $4 billion gross impact from tariffs this year, is that the run rate investors should expect for next year?
So for next year, you know, we still haven't given any formal guidance yet because there are a lot of things that are changing. What we do know is we have an extra quarter to lap in 26 versus 2025. But with the Korea deal being finalized and what we would expect tariffs to go down from 25% to 15% as that deal gets finished, and then whatever can be done in Mexico and Canada, we think that there's a lot of opportunity for tariffs to be stabilized. And then when you apply our self-help, because we've said now that we can get about 35% of those tariffs met in the business by, go-to-market strategies, by our manufacturing footprint, and by really focusing on discipline in our fixed costs, we think that net tariff burden next year can be lower than it was in 2025.
I talked to a lot of CFOs, and this has been an environment where teams have had to get creative. You're not necessarily going to raise prices on a piece of apparel because consumers are stretched. Like, where have you been able to creatively raise prices to help offset tariffs?
Well, I think, we've got a new model year that has just come out, and, with every model year, we've got opportunities to add content and create value for the consumer. So I think we've been able to do that across the board. But I think it goes back to that discipline strategy. So our incentives were about 300 basis points below the industry average. And that's a testament to the quality and the refinement of our vehicle portfolio. We've got a lot of strong demand that allows us to lean into that and work with our mix on our trucks and our full-size SUVs to help bring up some of that revenue and that margin performance to help offset it.
Is the consumer resiliency surprising you?
I wouldn't say it's surprised us. I think, at the end of the day, we've had a lot of strength that has really kept up for the last several years in the face of a lot of adversity. So many of our customers across the board, we've seen increased demand for higher trim levels over the years, et cetera. It's held up pretty well. But also when you look at our portfolio, we're also at the low end of the cost side on vehicles with the $20,000 Chevy Trax, for example, that we've had tremendous success in. So I think being able to be a global producer that allows us to package a portfolio of vehicles across the consumer spectrum has really served us well.
GM CEO Mary Barra talked about in her shareholder letter for earnings, onshoring or reshoring of jobs. Walk us through how this will unfold over the next few years in terms of bringing jobs back to the U.S., and will you be building more plants here to support that?
Well, really what we're doing, Brian, is kind of shifting some of the undercapacity that we had in the U.S., filling that up and shifting that to other plants globally. But Orion is a great example of that. This is a plant that we were bringing up for a lot of EV demand. That's clearly not going to happen over the next several years. So instead of continuing down the path of making a lot of EVs that the customers maybe aren't ready for at that level of demand, we've shifted that into internal combustion engine production. Gives us a little more incremental production on full-size SUVs, but allows us to domestically produce a lot of full-size trucks that are going to help to ease that tariff burden going forward. So that'll come online at the end of next year in early 27, and we're very excited about that. And I think it'll be a big win for our customers.
In this regard, are the president's plans working?
I think they are for us. I mean, he's always supported the U.S. auto industry, and I think this is a really important industry for the country as a whole. And as we look at that tariff burden, making sure that we raise the concerns about ensuring that we're competitive with all the importers that are in the market, things like the MSRP offset expansion have really helped us in a way. I mean, ideally, would we rather not have tariffs? Probably. I mean, our margins would be about 300 basis points higher, but this isn't something we're making excuses for. We're just going in and trying to perform, and we think we can be on that path to get back to 8 to 10% margins.
If I read the earnings release correct, Paul, what, a $1.6 billion charge almost for the EV business? What are your EV plans and why are you scaling things back?
So, if you look at what we've done over the last few years, we were building a lot of capacity because the regulatory environment was pushing us into a world where we were going to have 40 to 50% EVs required by 2030. Clearly, natural demand hasn't gone there. We've seen some increases in that. We're seeing a little bit of an adjustment right now as the consumer realizes that the $7,500 consumer tax credit has gone away. So it's going to take a little while for that to stabilize, but we think it will grow naturally, but it'll be much slower going forward. So we've got to go in and fix and right-size some of that extra capacity that we think we're going to have for the next 5 years. That'll allow us to be more efficient with our incremental production and grow in relation to where demand is going to be. So the $1.6 billion in the third quarter represents some capacity at Orion, some tooling and some equipment, as well as the CAFE credits, which the president changed earlier this year. So as we look at that and filling that up going forward, we still have a little bit more adjustment to do on total EV capacity, but we think it'll position us to win for the long term.
Are EVs still a viable business longer term?
Yeah, we think for sure they are. And when you look at the success that we've had, we've clearly established ourselves as the number 2 producer of EVs in the United States market.
They're good.
And I had a ride in a Cadillac Escalade IQ this morning. It's an amazing
I know, I saw it parked outside the New York Stock
across
Exchange.
the board.
It was great,
so we can help you get one if you're interested in purchasing one. But it's a vehicle that has all of the range and all the performance capabilities. And I think it is going to be the future. This slower demand is going to give us an opportunity to improve our battery chemistry and our form factors, realizing thousands of dollars per vehicle or savings, and ultimately be in a position to scale up as the consumer does. But we think they're going to win in the end.
One number among many that caught me by surprise was the performance of GM Financial. I mean, profits up year over year, but this comes at a time we've seen the Tricolor bust, we've seen First Brands bust, concerns about people not being able to pay off their auto loans. How do you see this unfolding from a GM perspective over the next year?
Well, Susan Sheffield and the entire GM Financial team do an amazing job of making sure, number one, they're serving our customers, but number two, they're protecting and strengthening their own balance sheet across the board. So when you look at the credit quality of the loan portfolio as well as their availability to consumers, I don't think there's anybody better in the captive industry than what the GM Financial team is doing. And it's clearly been a strong asset for us in helping to be creative to meet our customers where they are.
Do you see a problem happening, though, in the industry? We heard CarMax even talk about people not making car payments. Like, how bad could this get?
Well, we've got mostly significantly a prime portfolio, so we've seen a little bit of changing in delinquencies, but nothing that is really different to the sort of pre-COVID era where a lot of customers had money in their pockets after the COVID grants and so on that went out. But we're not seeing anything that's unusual in terms of delinquencies across our customer base.
I thought your note was so interesting because you talked about GM as an enormous ship, and in the past it's been tough to turn that ship. But you say they're getting a little bit better at doing it. So how are they getting more nimble at GM?
Thank you, and good morning. Thank you for having me. I've been following for GM for over 40 years, and it used to be used as a crutch, as an excuse. It takes a long time to turn a big ship. You go back to the late 70s, early 80s with some of the gas shocks. It took GM over a decade to adjust its product lineup. You look at the events that took place this year between changing the EV incentive and the tariffs. They've adjusted it in 6 months. That's a staggering change from the GM culture of the past. And so when I look at GM, a lot of it started with what happened in 2008 in the restructuring. They lowered the break-even level 50%. And quite frankly, I think Paul Jacobson's the best CFO to be in Detroit that I can remember. And he's got the entire organization reacting and acting incredibly fast, and that's led to cash savings. It's led to operating savings, and you've seen it translate into better performance at General Motors and better positioned to capture some of an improving cycle, in my opinion.
And so where does GM go from here? Not only, so operationally, as you've discussed, they've been more nimble. There's only so much they can do about end market demand, but how are those trends going to evolve?
Well, they've gained share in the U.S. in each of the last 3 years. They're up about a point year to date this year. If you become more nimble and you can get product to market faster that consumers want to buy, because normally the product development life cycle historically has been 3 to 5 years. If you can make those adjustments faster than the rest of the market, you're going to have the best product in the market. You're going to be able to get the best price. Right now, their ATPs are about $3,000 to $4,000 above the market, and their incentives are $2,000 lower. So they're getting better price on better products, and it's translating to higher market share.
Talk to me about tariffs for a second here, because obviously Mary Barra talked about some of the negotiating that they did with the administration, or some of the concessions perhaps that they got from the administration. But what are they also doing? I mean, it's not like they're not taking any hit from tariffs. They're still taking a hit. But what's your assessment of how they're managing all of that?
Well, I think when they first came out and they said the tariff hit would be roughly $4 to $5 billion for 9 months this year, everybody stepped back, and they said they'd be able to mitigate about 30% of it. Since that time, they've mitigated 35%, and the tariff impact has been lowered because of some of the changes that have taken place. And when the Korean deal gets signed, that will lower them even further. If we get progress with Canada and Mexico, you could get to a point that by the end of 26, that initial 4 to 5 billion or 6 billion annualized is entirely offset. I think you have to give a lot of credit to the GM senior management, Mary Barra in particular, and others within the industry. They've had a lot of back and forth and communication with DC, and DC has been able to help them in that regard. That comes from communication. If GM had stepped back and whined and moaned and said, this is ridiculous, we can't possibly compete with this, I'm guessing that the administration would have pushed back. They didn't. And they communicated, and you tip your hat to Mary Barra and the rest of her team for having a good communication, a good dialogue with Washington, and they've been able to make some adjustments where now it sounds like most of that impact is going to be mitigated by the end of next year, and suddenly, the company is more competitive and our U.S. economy is more competitive.
And Michael, I was just talking with Pras about the EV business, and I'm curious to get your take specifically on that. He said also that the company is sort of taking the approach that they won't get a real read on what they call the natural demand for EVs until next year, when all of these things, the incentives, non-incentives, kind of calms down. What do you think the natural demand for EVs is?
Well, I think, first of all, you go back to the early 1900s, and EVs were over 1/3 of the U.S. market. So that's a historical perspective. For decades, they had EVs that nobody wanted to buy. And certainly Tesla introduced that to the market, that if you have the right vehicle, people will buy it. EVs come down to a use case. If you talk to people that own an EV, no matter where they are, whether they're California or the Northeast, once they have one, they're not going back. And so to me, I've always wondered why, if EVs are that great, why do you need a $7,500 incentive? And so now we're going to find out. I think, EVs, if you take the old rule that California trends lead the rest of the country, California's at 20% EVs. That's my guess where we're going, 20 to 30%. Now, I think the government was trying to force it that it would be in 5 years. Realistically, it's probably 15 to 20. So by the time you get to the mid-decade, in 2035, in that time period, I would expect EVs to be somewhere in that 25 to 30% of the U.S. market. And again, it's all a use case, and people that have them love them. And so I think that will continue.
Do you think that GM will end up being a dominant player there? I mean, I know that's a little bit far away to be able to tell now, but who do you think, or is it still Tesla's game to lose?
Tesla has the strongest brand name. GM has the broadest products. And so GM also has the broadest service and distribution. The auto business is a service and distribution model. That's what it comes down to. And the strongest asset they have is that dealer base that can distribute and service the vehicles throughout the country. And so, yes, GM is going to be a leader. Now, is that 1/3 of the market? Is it 25% of the market? That's anyone's guess. My guess is it'll continue to be very competitive. The Chinese-based manufacturers will enter the U.S. market at some point. They have extremely competitive products at lower cost. And so that's going to be a competitive dynamic as well. So I think as you look at it today, GM once again has best distribution, the most broad product, range of products that they can offer. They're going to be a major competitor in the EV business in the next 5 to 10 years.
Michael, thank you so much. Really interesting stuff on GM and the whole auto business. Thank you.
Thank you very much for having me.